Welcome back to the Dividend Diplomats YouTube channel, everybody. Got Lanny and Bert, the Dividend Diplomats. We're here to talk to you about 3 undervalued dividend stocks to keep on your watch list.
Smash that subscribe button. Give Bert the Hurt and Lanny a thumbs up. Let's go. Getting that subscription base up. We love it. We appreciate you guys. And Bert just said it's time for another dividend stock watch list. We're looking at 3 more dividend growth stocks to buy right now.
Exactly, Lanny. Finding an undervalued dividend stock in this stock market can be pretty difficult.
Why?
The S&P 500 continues to touch record highs and hang around these highs that are set. We've had some good days, some bad days, obviously, but the overall trend is upwards. Look at that PE ratio of the S&P 500. What is it, Lanny? What's it crossing?
It's almost at 45 times current earnings. And if we were to actually look at the forward PE ratio right now, you know, the Y charts is currently anticipating it's around 21 on forward earnings, but they're looking into 2022. So it's still in the 20s, hitting the mid 40s on the valuation mark. That's a sign of overvaluation. You know, the stock market, as Bert always says in the videos, is typically between that like 18 and 22 benchmark, but right now trading at 45 times current earnings is a little wild right now.
Yeah, for historical standards, this is very expensive. But again, as always, if you've seen on all of our videos, you've seen on our watch list, on our blog, we still find a way to find undervalued dividend stocks to buy. We're always running our stock screener to help us complete this research and find these companies to buy. Lan, you want to quickly run through the metrics of our stock screener?
We'll make it quick. You know, for those that are new to the channel, we do have the Dividend Diplomat stock screener, keeping it simple with 3 metrics. One being the price to earnings, which is taking the share price over forward earnings, looking at below 20 times earnings or below the S&P 500. We do like to look at them against competitors as well. Second is the dividend payout ratio, and that is the current dividend over those earnings. And Bert, you always preach about the perfect payout ratio. What is the perfect payout ratio?
I do like to preach about this. We think a perfect payout ratio is between 40% and 60%, because that is the perfect balance of a company reinvesting earnings into their business to continue growing their operations, growing those earnings and growing that dividend, but also paying us shareholder a very nice dividend as well. If a stock's below 40%, we're still going to consider it. It's still a good company because the payout ratio is indicating signs that that dividend is safe, but we just love that perfect balance in the middle. Nothing wrong if it's lower, but again, look for that 40 to 60 sweet spot.
And at 60%, you know, kind of ceiling, we like to look at because of just from a safety standpoint to make sure there's no signs of, you know, risk of a dividend cut, as well as knowing that, okay, dividend growth should remain strong going forward.
Exactly. And that third metric that we look at is that dividend growth that Lanny just messaged. It was a perfect segue, Lanny. Thank you. And for that, we look at the 5-year average dividend growth rate to see if it's above inflation and just how high and what size are these dividend increases that we're watching. And then we look at how long a company has been increasing that dividend.
There it is, the Dividend Diplomat stock screener, guys. All right, but here we are. The S&P 500 is over 4,200 right now, and they've hung around there for the last week since we did our last videos, essentially.
Yes, they have, and these are going to be 3 new companies on our watch list.
Had them on there.
Yeah, these are going to be the first time they're making it on there, and it's very exciting to see these companies. I'm looking at the list, and we cannot wait to tell you about them.
You know, the name of the game is buying undervalued dividend stocks. We do it because we want to increase our dividend income. Because Bert, why a dividend income?
It's the easiest form of passive income.
Boom.
You can earn dividends while you sleep. You just open up in the morning, you look, oh, dividends hit my account.
While you open Pokemon cards?
Yeah, exactly. You then also look at the news, you see, oh, my dividend just increased by X%. You didn't even have to lift a finger to do it. The most difficult thing was typing it into the browser to see if that dividend increased. That's why we love it.
Exactly. And, you know, so we put together this dividend stock watch list. You know, we keep refreshing the watch list because stock prices, valuations continue to change. And Bert already said it, we're bringing 3 new dividend stocks to this table. And really, when you look at the first 2, I think there's 2 words you're going to see here: dividend growth. And that's the power behind the first 2 companies.
Yeah, because this first one, and let's start rolling into it, just announced an absolutely insane dividend increase, which we talked about in one of our last videos.
Bert, what is this first dividend stock on this watch list then?
It's Lowe's, ticker symbol LOW. Bet you weren't seeing that, thinking that was going to be on our watch list today.
We're going to bring out the Hogan Lowe drop right here.
Oh, I see what you did there. But in seriousness, they just announced a 33% increase to their dividend.
Man.
And I mean, our expectations were double digits for sure, 10 to 20%, which would have been in line with that 5-year average, which you'll see. But holy smokes, Lowe's shareholders. Congrats on that 33% banger of a dividend increase.
DIY is not dead. Home improvement, you know, everybody has been working on projects. You know, building costs are going up, which, you know, obviously Lowe's sells a lot of these products.
Yeah, and if you go to the store, the lines are incredible. They're out the door. People want to get there. They're working on their yards right now. So yeah, people are looking to do whatever they can to make those improvements. Yeah, tell us about that, Landon.
Yeah.
But that's why Lowe's, Home Depot, and other home improvement stores continue to crush it. And of course, it makes sense they increased that dividend 33%.
33%. They went from 60 cents per share per quarter to 80 cents. But Bert, their stock price has gone up, gosh, from $120 this time last year to almost $190. What is that first metric?
Well, I was going to say, how could we beat this company on our watch list if their stock price jumped up that much? It's because their earnings are growing that much too, and what they're projected. So let's go into that. Brother. Let's go into that metric. Their price at the time of this video, $189.91. Their estimated forward earnings are $10.96, and that's a PE ratio of 17.3. Below that 21 number you said for forward earnings, the S&P, and way below the historical current 45 PE ratio.
Bert, I mean, you're thinking it's already great right there with a low price to earnings ratio, which again shows signs of undervaluation. But Bert, I think you're going to love the next part. What's that next payout ratio?
Yeah, so after this increased dividend, their annual dividend is $3.20. That's what's funny about this. Take that divided by the earnings. Even after a 33% increase in their dividend, their payout ratio is only 29.2%. Only 29.2%. They've got plenty of room to keep announcing 33% increases year after year after year. So that shows you dividends growing, but that shows how much earnings are also growing along with the dividend.
And then when we slide into that third dividend stock metric for Lowe's, we got to start with how many years they've been increasing their dividend.
Yeah, you tell me, Lanny.
I'll tell you something, brother. So Lowe's actually is not only a dividend aristocrat with 25 years, but they're actually a dividend king with over 50 years. And in fact, this is their 60th year of juicing that dividend going forward. And Bert, that 5-year growth rate.
Insane. Is 16.12%. So they doubled up that 5-year average this last year. But it also shows you that they are consistently announcing double-digit increases to their dividend. This wasn't an anomaly with 33%. The size of it was, but they're still increasing and giving you strong return and growth every year.
The consistency in seeing a rock bottom and then the people's elbow, you know what's happening.
Yeah, and then a few kicks on the side there. But what's cool about them too, with this dividend increase, their dividend yield is 1.7%.
The bonus metric.
Yeah, we always like to compare that after they crush the first 3 metrics. The yield's in line with the market, so you're getting a market level yield right there, but then also a 33% growth rate on top of that in that dividend.
Yeah, so for those that don't have a home improvement store in their portfolio, Lowe's is not looking too shabby.
It's not. You want to tee up number 2 for everyone, Lanny?
All right, teeing up number 2 right now, we're going into the technology sector. A tech company on the dividend stock watch list, let alone the dividend diplomat stock watch list.
Yeah, there are tech companies that pay dividends. We have covered them, we bought them, and they are in our portfolios, which we put on our website, and we'll put a link to below. But tell us more about this tech company.
So my wife actually owns them, and it's a big software company, cloud-based company as well. We're talking about Oracle, ticker symbol ORCL. And they're big into those enterprise platforms for large companies, small companies, you name it. I mean, that's their name of the game, and their cloud business is really like the big pusher right now.
Yeah, that's been what's cool about Oracle is they aren't just massive companies. They know how to cater to everybody. And then once you're in their network and in their platform, they get their softwares into your company. Good luck leaving it because the switching costs are very high.
Yeah, so many platforms are Oracle based as well, so you don't even know sometimes you're actually using an Oracle platform until you actually see their little logo.
That's true, and that's why we like companies like Oracle, and we're happy to see them pay a dividend and feature them on our watch list, because once you're in the switching costs and all the different revenue streams you have, which you articulated, that's going to help fuel your earnings growth and help fuel dividend growth in the years to come.
Yeah, they've also had a nice price surge in the last 52 weeks, but they're still on the watch list for very valid reasons. Currently trading at $82.89 as of the June 4th close. Forward earnings right now are looking at $4.46 from the analyst. So if you do the math, that first dividend stock metric, their price to earnings ratio is only 18.5.
That's fantastic. And let's roll into the dividend. Their annual dividend's $1.28. Divide that by the earnings. Another really low payout ratio of 28.7%. So another company has plenty of room to continue growing that dividend for years to come.
Similarly, as we talked about the dividend growth rate with Lowe's, there's a very similar story here with Oracle. Not really from a streak standpoint because they've increased their dividend for at least 8+ years, but that dividend growth is pretty awesome. This year they increased their dividend, I think around 30 to 33% as well.
Another banger.
From 24 cents to 32 cents, I believe, per quarter. And that 5-year growth rate, because when they increase their dividend, it's usually on like a rotating 2 years, but from a technical standpoint, it still counts. It counts
because the payout increases, but it's not your consistent every 4 quarters, boom, here's your next one.
So yeah, that 5-year growth rate ends up being around 12%.
That's perfect. And yeah, what they've increased it, you said, for 8 years, so that's perfect. And then let's look at this yield. Right around Lowe's, slightly lower, it's 1.54%. So another company that's in line with the market with strong dividend growth.
That's great. Now, Bert, when I think of consumer goods, there are many companies that we can think of, Procter & Gamble, Colgate, there's quite a few of them in the industry. But this one has really hit news because of the share price and kind of their latest earnings maybe wasn't as great, but it's a huge company.
Yeah, and they have been expensive, and because of that poor earnings, they are now starting to pop up on everybody's watch list because the metrics are looking great, as you'll see. The company is Kimberly-Clark, ticker symbol KMB, and yeah, their brands are right there competing with Procter & Gamble all the time.
Oh yeah, the headbutts, right?
Yeah. So
the toilet paper, I know you're looking at both. You're like, which one do I take?
Yep, and you flip it over. I'm like, I only own Procter & Gamble, so is the price the same? Yes. Procter & Gamble goes into the cart, but maybe that'll change with Kimberly here.
That's right.
But what we love about consumer staples is they're always in your house. Good times, bad times, you need the toilet paper. You need the products they sell.
You need it. You got to get your hands on it before somebody else does.
Well, last year that was a true statement. Last year when people were hoarding toilet paper, they were hoarding these supplies. It's sad that it was true, but it was part of what we had. But Kimberly-Clark, great consumer staple, strong dividend growth history as you're going to see. Right. Let's dive into the metrics here. They're trading at 130.57 at that close. You'd take their forward earnings of $7.38, gives you a PE ratio of 7.7.
Nice. And then we'll go into the second metric, dividend payout ratio. So this cottonelle producing, Scott making company right here pays a current dividend on an annual, quarterly basis, but in total pays $4.56. So you take that over the projected earnings of $7.38. The payout ratio is very similar to like a Procter & Gamble, but the payout ratio is just over that 60% threshold at 61.79%.
Yeah, not really that concerned. It's just a hair above our 60%. There's plenty of room before it hits 100%, and that's what we're really concerned about because you can't pay out more than your earnings in the long run. It's 61.79. Not that worried about it.
Pretty similar to the industry. They're not a high-profile business, right? They're not here to say, "Oh, we had a 40% earnings growth this year."
That'd be awesome if they did, but no.
Yeah. If you do, please, that'd be great.
Yeah, and their 5-year average dividend growth rate is 4.43%, so the lowest on this listing here.
But greater than inflation.
That is true, and that is a very key fact. And they are almost in that Dividend King title. They've increased that dividend for 46 consecutive years. Fantastic streak. There's nothing more you can really say about it.
Well, what about that dividend yield, Mean Gene? You like it? At that 3.49%?
I do like it. So even though the dividend growth is lower here for Kimberly compared to Lowe's and Oracle, I like the fact that their yield is double the other two on there. If you're not going to have the growth, at least have a strong yield to go along with it.
That was 3 dividend stocks. Again, Lowe's, Oracle, Kimberly-Clark. Lowe's and Oracle, really the lower yield, but higher than the S&P 500, but higher dividend growth model businesses. And then Kimberly-Clark, your old churn and burn, steady Eddie stock.
Yeah, exactly. And they're 3 great companies. And for me, I actually don't own any of the companies. What's interesting on this list is I don't have anything in the home improvement sector. I've never actually bought Lowe's or Home Depot in the past, so this might be a great time to start slowly building up that position as well. How many of these do you own?
My wife owns Oracle. We don't own Lowe's or Kimberly-Clark. I'm really interested in Lowe's right now. Similar stance. Don't really have a home improvement store, and as we're doing a bunch of house projects, outside projects, I'm like, man, I'm either going to Home Depot or Lowe's, and all the Home Depot haters, I can't wait to hear it. If you're already a Lowe's shareholder, give it a thumbs up. I want to hear why.
Yeah.
So yeah, really interested in Lowe's.
Perfect. So let us know which one of the 3 companies on this list you like, if any, or all 3. We're excited to see, and let us know what stocks you end up buying this week. And hey, if there are more than 3 undervalued dividend stocks out there, if we didn't talk about one that's on your radar, please let us know.
Bert, I want to hear a nice little Stone Cold Bert. Oh, that's the bottom line.
All right. So everyone, subscribe to our channel. Give us a thumbs up, because that is the bottom line, because Stone Cold says so.
Wow. You heard it here. We appreciate it, guys. Can't wait to the feedback. If you smell what the Dividend Diplomats are cooking. That was Bert, and this is Laney from the Dividend Diplomats. Over and out.